the first question I had for you, and we may have already, went through it. It says, let me ask you, is it true that mortgage rates decreased?
Yes and no. Yes, they have,
Okay.
but no, they have not to an extent either.
Okay.
Again, from where they were at the highs this year, yes, but
Okay.
every situation is different and every scenario is different. So
Okay.
I highly advise anybody looking right now to reach out to me or a trusted mortgage advisor and
Yes.
get your rates. They are changing on a daily basis. Nothing is ever set in stone in this industry.
Okay. And so with that, you said daily basis. Do mortgage rates change daily?
They do. They do. They're very small, minor changes unless something really big is going on, but they do change on a daily basis.
On a daily basis. Okay. Okay. So what's the overall rate that you're seeing right now? Because I know they change on a daily basis, but what's the rate that you're seeing?
The rates are
People come
floating
in.
between 5 and 6%, depending on what loan product we're doing and all the qualifying criteria.
Okay. And so with that said, let's move a little further. What is the credit score that's needed or the standard base, because it gets a little shaky because we know there's a lot of other things that are taken into,
Sure. So there's not really a standard credit score, right? I mean, we have to pull credit, we have to look at the scenario, and it's not there's not one specific cutoff credit score. There's guidelines and there's rules. Every person's different and unique. So that's a great question, but that's one that's really hard to pin down.
Hard to pin down, yeah. But you answered it great. There is no standard. So what that tells us is, hey, you guys, when you get with me and I tell you I want to get you to my preferred lender, oh, I don't know but that's the good thing. You don't know, but let's see where you stand. Isn't that what we always say, Clark? We said
exactly. You don't know until you know, right?
Until
and
you
don't
know
until you ask, and asking is half the battle. And we're here to help. We're not here to judge or to worry about anything. We're here to help. So
right, exactly.
If there's a situation, reach out to us. We deal with unique stuff all the time. We can always make something work.
Yes.
Or give you advice to get you where you need to be to get where you need to go.
Correct. That's right. That's what we're here for. So, okay. So people always ask, well, what's the credit score? What do I need? I just wanted to ask that. There is no specific credit score.
Correct.
All right. So my second question for you was, and I think we already answered this one, was we now know, it says, how did mortgage rates decrease, but the federal rate increased on a 75 basis? And we've given that answer. So we know that now, we know that the basis rate is based off of the consumer debt, and our mortgage rates are based off of the treasury.
Correct.
All right. So thank you for clarifying that. And just because the treasury goes up doesn't mean that mortgage rates are going to go down or vice versa. Right? Exactly. So yeah. Okay. And we also know what determines mortgage rates. Can you tell us that one more time? What is it that tells us what mortgage rates are defined on?
Mortgage rates are determined by several factors.
Okay.
Income, debt to income ratio, credit score, and a loan to value of the property. How much down payment you're putting. The more money you have to put down, the lower loan to value, the better the rate potentially will be. Your rates are going to be higher for first-time home buyers that may not have a lot to put down, things of that nature. But again, those are kind of your core components. Everybody's different and it's always unique.
Right, as always. And so I think we've all heard about, that debt to income, the credit score, the loan value. But when it comes to income, I have ran into some clients where their credit score was good. And one where we just recently, me and you just went through it, but the income was a little low. So how do they know, because my client was frustrated. It was like, I've been working on my credit, I don't have much on there. I've been at my job for this many years, but I'm not being approved, and it wasn't you it was another bank that just totally walked away from them. But
I said no. Yeah.
Yeah, and with no education, as we say again, with no education. But what is it when it comes to like income? What kind of, can you give us some revelation on that income piece?
Here's the easiest way to look at it, right?
Okay.
Income is different for everybody, and everybody's obligations are different. We look at your debt to income ratio. And the big thing, I'm going to quickly walk through how to calculate that. This is what is key to getting your loan.
Right.
What you want to do is go look at your credit report. Go look at all of your debts, student loans, housing, everything. Add it all up.
Right.
Take that number and divide it by what your income is. And it will give you a decimal number, whatever that decimal number is. As long as it's generally 45% or less, we won't have a huge problem. Of course, there are other factors that play with that, but a good starting point is around 45% or less.
45% or less. Okay. So I'm going to be honest.
Equation. It's nothing difficult.
Oh, and I'm going to be honest. Like I say, hey, I'm the realtor expert. I'm the houses expert. But when we went to class and getting educated, we were told that it was like it was 28% and 40%.
So there's front end and back end ratios. Yeah. So there's front end and back end ratios. Your front end ratio is how much house you can afford. And that 28% that you heard is based off of, they don't want you to have a more than 28% payment over your income.
Okay, listen up. We're learning. Go ahead.
I generally look at the back number, the 45%. Depending on if the income's lower, that front end number may come into play a little bit more. But generally, the back end number is more what you're concerned about, because that's taking everything you owe and adding it up. So, whereas the front end is only looking at what your new housing payment might be.
Okay, that makes sense. So for the income, you guys, it's the debts divided by your income, and you want that to be at least 45% or less. And so that's good, because as a realtor, I always like to educate my clients before I get them to you. And we just like to make smooth transitions. So I talk with my clients. Hey, what's your credit score? Hey, payments matter. I want no late payments, you guys, within how many months, Clark? No late payments within.
You got to have no late payments within the last year, basically.
The last year, so that's right. At least the last year. We're going for at least the last year, and we can do this. We can do this. So, and now I know to let them know that 45%. And
one thing I do want to say on that is a general range. There are some loan products that will allow you to go up to 50 or 60%. VA loans and FHA loans, for example. But generally, we want to see 45 or less. A lot of lenders have what are called overlays that kind of, they lay over what they want as a requirement on top of what the requirements are for the loan product. We don't do that. We look just at the loan product itself. So, base it off of 45, but don't hesitate if it's a little over. We may still have something we can help you with.
Man, so he can maybe still work some magic, ladies and gentlemen.
Exactly.
We work hard for our clients. Okay.
Yeah. Miracles happen every day.
Miracles happen every day. Say, this is revelations. We got it. So, and then you also said that this decrease was not for all mortgage products, correct?
No, the decrease is for all mortgage products, but it's scenario based. So again, it falls back onto what your picture is whenever we put it in to look at everything.
Okay.
So rates have gone down across the board, yes, but we're not sure where in the portfolio you would fall. We would have to look into that.
Okay. So that's a positive. That is a positive.
Exactly.
So
that's giving more purchasing power, which is more
purchase. Exactly, and that's what we're saying. More purchasing power. So when you come to me, hey, it's maybe instead of that house that was 110, we might be able to move up to 120, 130. A little more purchasing power. So that's how these things play together: the interest rate and what you can go buy, things of that sort.
Right, 100%.
Yeah, and so and we did the DTI. Are there any requirement changes? You may have, went through this, but are there any requirement changes right now?
So guidelines are changing on a weekly basis as well. Guidelines are what, we have to follow in order for the loan to fund. nothing that sticks out dramatically at this point. It's just small little changes that happen here or there. So yeah, guidelines are changing. Requirements haven't completely changed, but and that's something that we'll have to look at as we're going through everything.
Right. And there'll be part 2s and 3s and 4s and more. So we'll go deeper, you guys.
Keep it at the general level. Yeah.
A general level. So
changes, but nothing that I would be scared about right now, or nothing that should stop me from applying or what.
Okay. So this is what I'll say. So does this increase give a silver lining? Is it now a better chance for better rates for all applicants? Let's sort of end there and sort of wrap it up for you guys.
I would say yes. I would say that, this is a good time right now. Even though rates are up, you hear in the news that rates may continue to climb and gloom and doom. I think it's a good time to purchase still.
Yes.
Rates are still historically low. They're not 2 or 3%, but they're still low overall. And go back a couple of years, this was the standard.
That's right.
We got treated well during COVID, but we're still being treated well overall. It's not 10 or 12%. It's not the end of the world at the end of the day.
Right. And I will agree with you. I think COVID spoiled us.
Yes.
And now, like I say, I think we're normalizing, and that's what we're seeing. We're seeing that normalization coming back. These are still good rates, and so it is the silver lining. Like he said, it is a possibility that your product that you go in, your interest rate could be lower, and that give you more purchasing power to get that home that you want. If it's an investment, if it's the first time, if it's your 5th home, we're here to help you walk through that. So Clark, I really thank you, brother. Appreciate you taking the time to talk to me with at the Revelations of Real Estate. This is the first of many, so we appreciate you. And you guys will put our information in the bottom. Please reach out to us. Kyra Hodge with Stone's Edge team of EXP, serving the North Carolina and South Carolina areas. We're here for you. And Clark is here with Bayshore Mortgage out of Raleigh, correct, Clark?
Yep, out of Raleigh. But I do everywhere. I do North Carolina, South Carolina, and pretty much all up and down the East Coast.
Right. So thank you guys. Thank you for tuning in and coming, Clark. You guys have a great day. We're creating relationships, selling real estate. You guys take care. Bye-bye.
Bye-bye.